What is a market crash? What's the difference between a correction and a crash? And how can you protect your 401k or retirement account from future crashes? My name is Arman, and these are the questions that we'll be answering in today's video of Simple Money. Alright, a market crash is when the market suddenly drops by a minimum of 20%. Market crashes are typically caused by catastrophic events like when the bubble burst in 2008 or the pandemic at the beginning of 2020. The average 401k dropped by 30% during the 2020 crash. That means if you had $100,000, you lost $30,000 and you were left with $70,000. A market correction is when the stock market drops by at least 10%, and it does so due to predictable events. And even though you can't technically predict when a correction is about to take place, corrections are viewed as a healthy sign that the market is readjusting and that investors should reevaluate their positions. In either case, your retirement account would look much better if you didn't suffer any of those losses. Now imagine for a second that your 401k didn't participate in any losses and you were actually able to lock in all of your gains and keep them. How much money would you have by now? That's the power of protecting your 401k or IRA from market crashes. Now, the next question obviously becomes, how exactly do you protect your 401k from a crash? Simply put, the index strategy allows you to protect your account from any and all market crashes while still allowing you to participate in the gains of the market. And here's how that illustrates. So the market can typically go an average of positive to negative 30%, right? And if the market does negative 30%, then you stop at zero. Your account never goes negative. And if the market performs well and it does a positive 30%, then you get to participate in that gain. And obviously you won't get the full thing because you didn't participate in the losses. So you would get about half of it, 50%, which would be 15% in this particular example. Another way to look at this would be to look at the actual graphical performance of the markets. So this graph just demonstrates what a market might look like with its ups and downs. The dotted line will represent the performance of the index. And as you see in the first couple of years, the market has a much better performance and the index only goes about halfway. But when the market drops, the index just flatlines. So whatever you gained, that becomes your new principal balance and you'll never go below that amount. And instead of picking up from down here, you pick up from where you left off. And again, it's not as aggressive as the performance of the market itself, but when the crash happens again, you lock in your gains and you pick up from where you left off instead of picking up from down here. Now, real quick before we get into the next section, if you're finding any value from this video, if you're liking the video, please go ahead and subscribe to the channel. Make sure you smash that like button and definitely hit that little notification bell so that you get notified the next time that we drop a video. Now, an important note about this is that this is not a strategy that can only be done by almighty and powerful asset managers, because a lot of people talk about indexing, but what they're talking about isn't a contractual guarantee that you'll actually never drop below 0%. What we're talking about in this video are contracts that are only offered by life insurance companies. These contracts come in two forms. The first are indexed annuities. Indexed annuities, or IAs, are typically used for retirement funds, and most people will use these plans because they want to roll over their 401k or IRA without having to worry about fees or taxes because it's a qualified rollover, and then they get to participate in the index growth concept. And a quick fun fact for you, there was over $250 billion, billion with a B, that was transferred into IAs in Q4 of 2020. The second would be indexed universal life, or also commonly referred to as IULs. These plans are for individuals who have a need for life insurance, but they want something more than the basic term plan. By contributing your maximum allowed amount into your IUL, you put yourself in a position to gain interest rates based on the index growth concept while protecting your funds from taxes, from lawsuits, probate, and any other financial hazard. IULs are one of the favorite tools for the elite class because it gives them the option of legally protecting their money from income, capital gains, and estate taxes. Now, many advisors will argue against the fact that these two plans are as great as they are. And they do that because of one main reason. When a 401k, IRA, mutual fund, or any other variable account is actively managed by an advisor, they take 1% to 5% every single year as a management fee. This also applies to IRAs or retirement accounts that are set up through a bank. We did a great video on this on how banks make money off of you, and you can watch that right here. Now, this fee is charged whether or not you have a good year. Meaning, if the market crashed and you suffered a loss of 20% and their fee was 3%, they would still take that fee and your total loss for that year would be negative 23%. Conversely, if the market did well and you gained 10%, after they take their fee, you're left over with 7%. These fees apply to all 401ks, IRAs, or any other professionally managed or actively managed retirement account. And when you roll over your 401k or IRA into an indexed annuity, then you avoid the management fees because indexed annuities are not actively managed. Because the plan is set up to automatically avoid the crash and it gives you a predetermined cap or a participation rate, there is no asset manager that's actively managing an indexed annuity. The IA does it all by itself. And since that's the case, there is no asset management fee that comes with indexed annuities. So when you choose to transfer your 401k into an IA, you're taking that management fee away from these asset management companies. And they don't like that. But ultimately, it's not about whether or not they'd be happy. It's about whether or not you'd be happy. And I have a feeling that if you were able to avoid all losses, hold on to your gains, and remove all fees, then you would be a much happier camper. All right, that's all we have for you today. I hope you enjoyed the video and you got a lot of value from it. If you have any questions or comments, please leave it in the comment section below. We'll try to address them right away. And if they're really, really good, then we'll create a future video to answer your question. Thank you so much for watching. I'll see you in the next one. All right, thanks for hanging out. I hope you enjoyed the video. And if you did, make sure you subscribe to our channel, hit that notification bell right there, and then you'll get notified the next time that we drop a video. Actually, why wait? You can watch this one. Or even that one. So many choices. Did you do it? Did they do it?
No, not yet.